Hi, this is Randy Finney with the right side of the chart, and this is a late session update for Wednesday, April 7th, 2021. We have exactly half an hour to go left in the trading session. I wanted to get a quick update out on the markets. Nothing major today, but I wanted to touch on a few things, and there are some levels to watch. Actually, I should point that out on the S&P 500 futures. We'll start here with the Nasdaq 100. That's where a lot of my focus has been. Here's our trend line off the lows back in March of last year. So that's our primary trend line. It's been broken. We were heading lower, and we did have, this was a 12% drop in the Nasdaq 100. I think the futures dropped about 13% from high to low. And so definitely a correction, and that hit that 297 target right there, reversed. And so far, it appears more, at this point, it appears that the correction may have ended at the 297 level. We haven't technically taken out the previous highs, but what we did do is we broke out of this trading range right here. Again, highlighted quite a bit. Now, what we've done is we ran into the gap. That's really, I'm not going to call it the last stop or last chance resistance, but it was minor resistance there at right about where we are, 311 or so, and then you had that previous reaction high. So let me take a look at this. Let me show you a few other indicators, and let me really give you my thoughts here. All right, so we did stall out there. That's again, that line is roughly right where we are, 331. I should say, I might have said 311. 331, right about where QQQ is trading right now, and we hit it, and we've been trading on that level for the last few days. Remember, with the Nasdaq 100, it's all about these market-leading FANG stocks. So we have Apple starting to regain, poking its head above that 125.75 level, and if it can clearly put that in the rearview mirror, that's going to be bullish and should bring Apple up to that 138.36 and quite likely new highs, I think, if that level is recovered. We're still above the key 200-day simple and exponential moving averages. The red line's the exponential, that blue line there is the simple, and we're just recovered the 50-day, and so that in itself is bullish until and unless it fails. So again, starting to see money coming back into these tech stocks. A lot of these big market leading tech stocks have really peaked, if not here, a marginal high earlier this year, all the way back in August of last year. And that's been the story. They've been moving sideways, not going down, but not going up. Microsoft did recently make a new high, and it is above that trading range. Again, not by a wide margin, but definitely above it, and that puts it bullish as long as it remains above it. Trying to box it in there, and so that's that. Now, nothing's changed in the longer term outlook. The technicals, the divergences still remain very much intact, and we make a marginal new high. That's been the MO for, gosh, a long time now. Market or these key stocks would make a marginal new high slightly above the previous high with divergence and then correct. And here, trade, pop, broke out. And so far, the breakout of Microsoft, this has been one of the most bullish stocks of those market-leading FANGs that I follow, because we had the breakout and successful back test, and we held that back test of the trading range, and just recently took out the highs. I'm a little skeptical of some of these breakouts, I have to say that, but they are what they are unless they fail. In other words, breakouts. So there's Microsoft on a breakout. Amazon's still well within the trading range. There's a downtrend line to watch it's coming up on, but when I'm talking about the trading range, these multi-month trading ranges, so and also holding above the 200-day moving average for now. So let's just say these charts are near term, especially this one, neutral. This one has not yet broken out. But in the last few days, we've seen money coming into these FANGs. There's Alphabet Class A, the GOGL, nice lift up and a break above the recent smaller trading range right here. So all in all, hard to knock. But if these guys fail the breakouts, then we could see a quick move down. So again, if you're bullish and long, you can keep a tight stop on these if you're trading these individually, or if you're trading the indexes. I'm going to show you some levels to watch there. That's a level that the recent breakout is about 2117 in Alphabet. And of course, if that fails, you still have support at the bottom of the range, about 2005. Anything much under that would probably lead to a very swift drop, because this would be a kind of a WTF moment for the bulls. Breakout like this that was by all accounts legitimate, impulsive, and everything else, follow through so far today. So again, those are levels to watch. Facebook, same story. This one's cracking above the recent trading range. The bulk of the trading range was right here. A lot of those advances capped there, but you did have that previous high right there, and that has just been taken out. So again, until unless it fails, that's near-term bullish. Now let's look at levels to watch on the indexes. I probably should cover Tesla. Tesla's been dead money for a while now. Peaked back here on their fourth quarter earnings and divergent high, dropped about 38%, and it's still, it's only retraced less than half of that drop so far, and kind of stalling out and trying to well, not trying to pick a direction yet, it's kind of going nowhere. All right, let's look at levels to watch. Probably the most important level, I'm going to just jump to it, would be ES, the S&P 500 futures. And that is, here we go. Okay, so what I'm noticing on ES, I don't see a comparable trend line on SPY. It's similar, but it's more well defined on ES right here. This is a 60-minute chart. There's our uptrend line, and we have a divergent high at this point in time, just like you had back here. Divergent high, correction, divergent high, correction, divergent high. Even though that's not labeled here, you can see the divergence line, correction, and then you look for these divergent lows, and they're the next leg up. So divergent highs, I always say, are not sell signals. They're indications that a trend reversal is likely. What you need to see is a break of this trend line, and should we break, I'll give you a target right now for ES on a pullback. First and minimum target is right about here. That's a pretty good level, about 39.75. So there's a level to keep an eye on. And when we look at NQ, nothing much stands out on this 60-minute chart of the NASDAQ 100 futures. But again, I showed you QQQ. It did. We were stalling out at that gap from a few weeks back, and that's capped all trading. So that was that comparable resistance right there on QQQ, and we've been trading on that for the last few days. A little bit of divergence, nothing big starting to form. And but I suspect if the S&P 500 broke, we'll probably see the NASDAQ 100 break. And if so, a pullback target would be right back to that resistance zone that we just took out, and that is from about 13,342 down to about 13,286 or so. That would be an ideal pullback target. Anything much more than that would start to raise eyebrows, I think, but that would be a healthy pullback and also an objective place to recycle back into any long positions or cover a short. If we get that, I don't know what just happened there. Let's go back to the NQ chart. Here we go. If we get that, we're looking at a drop of about 2%, so nothing big. Could be a quick trade for an active trader. And if we break above the recent highs, and that's going to be bullish, it means Apple will hold that breakout, some of the other stocks that I just covered, and that will probably then cause the NASDAQ to run at and probably take out at least a marginal new high above that previous reaction and all-time high right there. Okay, and what's interesting is the small caps have been sucking wind lately. They certainly led the way for a while and put in this divergent high recently right here, and big, sharp, strong correction down to a divergent low right about to the previous reaction low, and since then rallied. But in the last few days, they've been selling off, and we're at support now or just below it, about 222 down to about 2204. And again, we've been stair-stepping lower all along, or a couple weeks back, I should say. I had a target on IWM, which came very close, but we didn't quite hit it, and that's this primary uptrend line off the March lows. Remember, the S&P 500 and NASDAQ 100 both took out these trend lines, but not the small caps. And so we very well may run at that. In fact, I was a little, not shocked, but a little surprised we didn't hit it. We got so close. Again, we stopped at that previous reaction low, but I had really good price support about 205 and the uptrend line. I still think there's a good shot that the NASDAQ 100, the Russell 2000 is going to go down and hit that, maybe even undercut it and go down and hit that 205 level. So something to watch going forward. It's kind of looking a little bit head and shoulder-ish too if I take off all the levels here, and looking not perfect symmetry. I didn't do a good job drawing that, but I think you see where I'm going. Almost a left shoulder here, head, and almost a right shoulder there. We'll see how that pans out. So all in all, really can't knock this market. Like I said, some relative weakness in the small caps recently, but the Nasdaq 100, which for a long time has been suffering, has started to perk up, and with many of those FANG stocks, coming under buying pressure recently in the last few days. Just look at all the green candles here on Apple, Microsoft, again for about the last week, steady buying underneath those. And again, more important than that, just a week being up or down when you're in a trading range really doesn't mean much until and unless you start to break out. And again, that's what we have in some of these names, such as Apple, Microsoft, Facebook, and some others, with Apple taking out that level. One thing I wanted to follow up on a few of the indicators that I've highlighted in recent months, and one of those, this is the first time in a long time that one of my more reliable indicators, I call it my low volume indicator. That's where I overlay a 10 period or 10-day exponential moving average over the volume on the major index tracking ETFs such as SPY, QQQ, and IWM, and it's always done a great job. When you fall down to those levels, I have two lines, really red and yellow, so call that the low volume threshold. When you hit that level, you can stay there for a while. So what happens towards the end of an advance, volume tapers off down to these extreme low levels, and then the sell signal comes, well, on multiple things. We look at breakdowns such as that 60-minute trend line on ES I just showed you, or on SPY. And then coupled with a expansion in volume, finally volume starts to expand, and this is all the biggest drops that we've had in the S&P 500, and they've been accurately predicted. We were able to get in there early on these. That was a 21% drop or so right there in the fourth quarter of 2018. There was a big drop into the March lows of last year, and again, all signaled. You can see these lines by first you had the tag of the level. Sometimes it's a one and done, and then the correction set in after. So you're looking down here where the little boxes are showing you when the low volume was hit. This was an extreme, persistent reading, and then boom, volume expansion. But this time around, and that last time too, we had a nice correction there, and that was also signaled by the indicator. But this time around, it didn't happen. We had the signal fire, we had volume expansion, nothing big, but we never got that correction. So I just wanted to point that out, that this has been an unusual market. I've had so many indicators that have for so many years triggered or signaled a much bigger drop than we've already had. And my question is it coming? Is this a little stay of execution, if you will, for the S&P 500 or not? Like I said, recent price action has been bullish in QQQ, and unless those breakouts fail, we'd have to see a lot of the market-leading FANGs start to get sold off soon, and then that would be a false breakout. Otherwise, like I said, can't knock it. Now, its indicator did a great job in QQQ. We had, again, a 12% drop from high to low in QQQ, this most recent correction, and that was it signaled in advance, by the volume, the drop to those extremes, and then boom, right there, you got the volume expansion right on this line. That's when the correction started, and that was the 13% drop in the futures, about 12% in the index itself. Which that's regular hour trades, of course, on QQQ, 9:30 to 4 p.m. You had it right here, and again, it's been a very reliable indicator. So in other words, not a failure or a whipsaw on the Qs, but it was on the SPY, and that is, again, unusual. But as I always say, there is not a single indicator that's 100% effective. But let's look at a few more, and then we'll wrap the video up. I didn't want to make this a long video. Let me show you this. Let's go to. There's a couple indicators that I've pointed out recently, and they're still potentially in play. And that is, first one here, this is the percentage of stocks in the NASDAQ trading above their 50-day moving average. That's this indicator down below. And what I do is I look for divergences. These lines here are negative divergences, and they often precede corrections. I've measured some of these out. I have to redo this chart. I need to put this one in log scaling. What you have up top is the NASDAQ 100, this line here, the brownish line. And unfortunately, it's not in log scaling, and this is what happens. This is why I like to use log scaling, and I have to Don't know why when I did this chart I didn't do that. I'll have to revisit it, but then I need to redo all these measurements. I just wanted to get this out today. This is a 56% drop right here. That's the bear market from 2007 to 2009, and it looks like a little blip. It doesn't look like anything. So I just want to read out when these divergences came, you had drops at range. This is, you probably can't see it in the video, that's about 9%, 9%, 15, 17, 6, 5.5, 11, 10, 25% drop, 29. You can see, you know, these drops getting bigger and bigger. And I just wanted to point out that for the first time since that 29% drop last year into the March lows, this is the first time we've had negative divergence on the NAA 50R, which again, it's the NASDAQ percent of stocks trading above their 50-day moving average. So that one's there, and that has not, it did play out. It did for that 12% drop, but again, on average, usually, at least in recent years, these drops have measured well into the double digits, 24 and 29 right there. So, you know, and it's not just the NASDAQ 100. This is the S&P 500 percent of stocks trading above their 50-day moving average, and the same thing. You know, you look for these divergences. That was a near bear market back in 2015. Again, not using log scaling distorts it. That was at 55% drop in the bear market back in 2007 to 2009, that is. And here it is. So I just want to point out we have this divergence. Now, this divergence is not confirmed. We'd need to see this line start to go down. That would then put in a lower high. What do I mean by that? Well, it can keep going up, up, up and burn through the divergence. And sometimes that happens. But again, this is what it looks like. Steep uptrend line on the S&P 500 there, and we have that divergence. So the last time we had the divergence was right here on that big drop into the March lows. So there's that. There's a lot of others. If we go to my sentiment indicators, we were just looking at breadth indicators. You know, when you're looking at the percentage of stocks trading above or below their moving average, that's the breadth indicator. Sentiment is, you know, how people are viewing the market, and there's one again that's it has a great track record. But what's happening is firing these signals that haven't yet played out, and they may, and that's why I'm doing this video. So as you know, as bullish as the price action has been recently, these long-standing, you know, tried and true indicators, again, not 100%, have been firing some warning flags, if you will. And so what you have here, and I've shared this one many times, this is the AAII Bull-to-Bear spread. So what it is, AAII stands for American Association of Individual Investors, I believe that is, and they do a weekly survey of their members, whether they're bullish or bearish, and it says, you know, do you expect stock prices to go up or down from here? And it's a contrary indicator. In other words, and I always say this, it's only useful at extremes, nowhere in the middle. I find it completely useless if you're trying to extrapolate any useful data when you're not at extremes. So what I've done over the years is created a red zone that I consider to be extreme reading, and that's about the 30 level right there. And so when you get to that level, it means you have excessive bullishness, and I have a green buy zone down below when you get to that level. This excessive bearishness. So basically you want to be going long right here when everybody else is bearish. And right here, boom, you hit that. Look at those buy points. You hit it there. That you didn't hit it. It came close, but you didn't hit it. Hit it right there. And again there, there's a follow-up reading. And you hit it right here. And again, you can see right there, that was the end of the last bear market, or the one from 2007 to 2009. You had an extreme spike down through there. Okay, and then what happens sometimes during bear markets, you're going to get these firings, and you had bear market rallies, but it didn't go very far. In a bull market, they're usually one and done readings. Now let's flip it around. Okay, so that was then, this is now. So on the flip side here, you get in the red zone, and that's usually when you have corrections. Here was a big correction. This was almost a year of a correction back in 2011 to 2012. You can see my year breaks down here, and that was well into the double digits right there, and that was preceded by that extreme bullish reading. Again, we never hit a sell signal until right here, and that was followed by a correction right there. And we had some little tags along the way, and this was a strong bull run, but there were corrections. These were all tradable corrections. Don't get me wrong, they were probably 6 to 12, 15+%. Then you had a cluster. These clusters will often lead to much longer, prolonged drops. That was that near bear market or bear market from 2015 to 20. It was about a year and a half where we traded down to sideways. Stocks didn't go up for almost a year and a half. In fact, they went down from that level. Two big corrections in there, and that was it. The last time we hit or since then, the first time we hit it was back here, right around that fourth quarter of 2017, early 2018, and look what happened. The market peaked there, had a correction, made an equal high right there, and then boom. So all this, it would have been a great time to get out of stocks. You know, they didn't go down initially. They had an initial leg down, came back, made an equal high right there, and then had the big drop right there, which once at that point when everybody got bearish, that's when you wanted to buy. And so where are we going with all this? Well, here we are. We had a signal fire there with absolutely nothing in the S&P 500, as if it didn't happen, and now another one. So this is a cluster, just like this. We now have two readings in close proximity. This one was most recent. This is last week or so. And there we are without any type of correction. So this right here tells me that the risk reward, despite the strong, price action right now and the resilient trend, we're setting up for a correction. And why does it work that way? Why do these contrary indicators work? Because again, if everybody is bullish, and again, I'm not speaking literally, metaphorically speaking, so the majority of people are bullish, that means most people that are interested, those that invest in the market, or already have their money in the market. And that's why, same thing when they're bearish and everyone thinks the world's coming to an end, they've sold out, they've capitulated, and that's usually when the selling ends. So there it is, guys. This is a very reliable, or has been a very reliable indicator historically, and it's right now it's flashing a, I have to use the word very carefully. It's not a sell signal because this is not a time-in indicator. This is showing conditions that are building in the market. Sometimes they are one-and-done readings, but sometimes they are just, elevated bullishness that will eventually manifest into the form of a correction down here. The other one I wanted to show you are the put to call ratios. There's a few out there: the total put to call ratio, the index only put to call ratio, and this one, the equity only put to call ratio. And again, it's been one of my most reliable indicators for years. I have a buy zone up here when everybody's extreme bearish. Again, you have to go to extremes to find useful data here, but that's usually when you want to buy. You had a buy signal there, and that was a big rally back then, right here. And then you bottom later, and then led to that uptrend. You had a buy signal right here, boom, buy signal right here, boom, right at the lows. So very, very, very reliable. This was the end of that previous bear market. There was a heck of a rally in the bear market in '07. That was in the fall of '08 right there, and it was very tradable, 20-something+%. Then you had a follow-up reading right there, right when the bear market ended, and so that said buy, buy, buy. So right there, about 100% reliability. Other than this reading that came early in the bear market, it was a bear market rally, but there was a lot more downside. And in a bull market, these have been great readings. Now, flip it around. I'm not looking at this right now. That was then, this is now. That was the low back in March. What we have more recently is these sell signals. When you get to this extreme bullishness, this down here shows you there's a lot more call buying than put buying, and everybody's bullish. And these were the biggest drops, and they were all preceded right early on by levels drops down to this levels there. So again, one of my more reliable indicators. These were one and dones. This is a cluster, unprecedented cluster of extreme bullish readings, and we're down to that level, and this clock has not been reset. In other words, there's not been a correction. So I'm still viewing these readings, I'm viewing these as still an active, it's again a condition, not a hard sell signal. In hindsight, or as time goes on, I may say this was a whipsaw signal. If the market continues to go up and these readings abate and we get back to the normal area up here and without a big correction, I'm going to say, well, guess what, guys? That had a great track record, but it didn't work back here. It still may work. Again, we're down at that persistent bullish reading, and it's more of conditions that have lasted for months now. And and will quite likely, if history repeats, manifest in the form of a correction and a double-digit correction, which again we did not have in the S&P 500. We had a double-digit correction in the Nasdaq 100. That's where my focus was. That's where my price targets were. The primary targets, it was my primary trading vehicle. Hit that 297 level. I did have additional targets that I thought might get hit, and they still could get hit. But we're going to have to see, for that to happen, we're going to need to see those breakouts in the FANGs and in the Nasdaq 100 fail, and we need to see them ideally fail soon. Otherwise, like I said, there's a lot of some near-term bullish price action in the market. But I just wanted to go over all these, and this is not comprehensive coverage of all my different indicators, but just the ones that stood out, such as the percentage stocks above their 50-day moving average diverging, put to call ratio still where it was months ago. I know I've been talking about this one for a long time, but we're down there. And again, you can just go back, we're spanning more than a decade here. So again, not many signals, and when you get them, they're pretty darn reliable. So that's why it's hard for me to get uber bullish with the recent developments, and I'm talking long term and even more intermediate term in the market. There's other fish to fry right now, such as commodities and then treasury bonds, which I'm going to wrap up because it's somewhat related to the stock market. Treasury bonds, ZN, I'm liking ZN a little bit more. This is the 10-year. I went long the 10-year yesterday for this reason. I'll show you here in a second. But we have this positive divergence that's been building, and we have yields, especially the long bond, the 30-year bond, is at resistance. Okay, this is the long bond ETF, TLT, which holds 20 to 30-year bonds, and it's at long-term support. This is a weekly chart. We have support about 134.42 right there. Goes back, it's these previous reaction lows, and more so I like looking at the yield, the 30-year yield. This is TYX. Goes back, what, a month now? A little over a month ago, I pointed out we were coming up here, and I expected TLT to reverse off this level. And so far, well, we certainly stopped there. We haven't gone down much, and that level is 24.16. You can see we hit it here. Actually, that's how far it goes back. I pointed out right here that week we had a pretty impulsive reversal after we hit it. And it's been 1, 2, 3, 4, 5, 6, 7 weeks we've been trading up below that resistance level. We ran into it and have yet to get over it. PPO looks like it's poised to make a high level crossover. RSI is overbought. Again, all stuff that I went over before. The last time we were overbought like this was back here, and you can see what happened. Yields went down. That means bonds went up. Remember, when you're looking at TYX, it's the 30-year yield. It's going to go, when it goes down, TLT goes up. Bond prices and yields move inversely. So again, that's a potential play for you. Hasn't taken off yet, but it hasn't gone the other way either. It's been, again, I'm showing you 30 years stalling out. You can look at TNX as the 10-year yield. Same thing. Just didn't have it at the same resistance level. It's certainly resistance right now because we've been stalling out here for the last few weeks. And what this says is if we pull back down, which I think we do to this target here, the uptrend line on TYX, again, that's a 10-year yield, and that price support there about 14.17. That would quite likely correlate with a pullback in the stock market, because if yields are going down, it means bond prices are going up, and what might cause that would be maybe a flight to safety bid. So it's still a trade idea. I'm not screamingly bullish on it, so just a way to be diversified. And again, the this is ZB, the 30, if you want to trade the long bond, it put in a divergent low, and it has been stair-stepping higher, just not very impulsively yet. It's working its way up. It needs to really get through this resistance level to run. So that's ZB. And again, I told you ZN. I like the chart on ZN a little bit better right now. Even the 5-year bonds. Let's look at those real quick, and then we'll wrap the video up. Here's the yield on the 5-year Treasury bond, and there's a primary downtrend line, and when we ran right into it. And so we have this little wedge type pattern, a little bit of divergence going on there. We put in a big divergent low, and so what happened, this is yields going up. This is the inflation trade. This is where, I think Powell's going to lose control. Long bonds keep going up. Everything but what he controls. He controls the shortest term, and not the 10 and 30 years. Those are set by market rate. So probably get a pullback in yields, which would be a rally in bonds. And then this is, for example, this is the 1 to 3 year Treasury bond fund, SHY, and I don't know if you can see it here. I'm scrolling in and out. Usually bond prices are going to find, they're going to trade around depending on economic developments and expectations of interest rates. But here's what happened. This is an artificial compression. The Fed does control the shorter end of the yield curve. And so yeah, it's hard to make out, but they're in this super tight trading range. And again, that's locked in. That's artificial. Market forces get down to the shorter term bonds, and they're more closely affected by, or going to track closer to the federal funds rate that the Fed sets. And you can see we've been in this very, very tight trading range. So at some point, you're going to most likely see this break out. And we're going to either break to the downside or the upside. But again, that's short-term. Trading these short-term bonds, you're not going to get anything. The rate they pay is next to nothing, the yield, and they don't have a lot of movement based on interest rate changes. So you want to trade that longer end of the curve. And if you don't trade futures, I mentioned ZN and ZB is the futures you can trade. But you can also use IEF. This is the 10-year Treasury Bond Fund ETF. Positive divergence right here, little bounce target there. You can leverage up, use a bigger position size because there's bonds don't move nearly as much as stocks. Or again, like I said, TLT broke out of the downtrend line, and I'll try to firm up some targets later on, but I'll still maintain this first when I have about 146. All right, let's wrap it up here, and that's it. So far, so good on the NASDAQ 100. The near-term trend is bullish. Price action has been bullish, but we closed the day right on that resistance level. So we'll see. We'll see if we can break out, and some of the stocks like Apple and Facebook and all those continue to move up and hold their breakouts, and Microsoft. We're probably going to see new highs in the NASDAQ 100, but anything is possible. So we'll just take this day by day. If we get rejected here, what happens? Does the breakout in QQQ fail? Where would that fail? Well, a move back below 324.65, a solid move. And then we'll watch those individual market-leading FANG stocks. And again, we'll just go from there. So for now, like I said, my primary focus on some of the select commodities and other things that have a little bit better risk reward profiles, such as sugar and some of those other ones that I highlighted. And a little exposure to bonds right now, being long, and a little bit of long equities, but not for just as long as this breakout sticks. I think it favors especially the large caps. That's where the trend has been right now. And there was a lot of consolidation in those market-leading FANG stocks. So if they can break out, if Apple can go to new highs and some of these others, they've been building up some energy like a coiled spring. So I like that better than the small cap arena right now. Small caps may go on down to test that trend line that I talked about earlier in the video today. Oh yeah, and gold as well. Still like gold for a long side trade. All right, let's wrap it up here. Get the video out to you guys. This has been Randy Finney with Right Side of the Chart. Have a great day.